All right, hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith. Derrick is the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. As a regular trader with T3 Trading Group, let's quickly just take a look at what Derrick is currently in. These are his current positions, what he's long, short, and already got flat for the day. So we've covered that for disclosure purposes. Derrick, the title of our stream today is Yield Spike, Stocks Drop. But we have had quite the bounce since I made this title earlier in the morning. So what's been your response to today's action? How have you been navigating today's session?
Sure. So I'm not surprised that we bounced off of lows. I was kind of expecting at least some degree of a bounce back, especially off the open. What I am surprised about is that we're having this conversation with the S&P at exactly unchanged, basically just about to tick green for the day. Incredible. This has turned into like the strongest market rally I feel like I've ever seen in my career. And it's been historic. April and May were both historic in terms of the moves on the downside and now the move on the upside. I've never really seen anything like it outside of COVID, but I still feel like COVID was a very different situation because during COVID, you just had stimulus coming from everywhere. You had stimulus coming from the Federal Reserve, from the federal government. This situation almost seems like the opposite, but we are still, believe it or not, in the positioning squeeze that you and I have been talking about for weeks. At this point, it's lasted longer in terms of the amount that we've moved up than I expected. I thought like a reach target was SPY 570 to 573. We're sitting at 594 just about as we're having this conversation. And we're also at the point time-wise where I wasn't really expecting the positioning squeeze to really continue. I thought that the positioning squeeze would be over by May OPEX. May OPEX was Friday. So we just got through that point. So maybe I'll end up being right. But so far today, we are seeing a continuation of just this crazy positioning squeeze. And it's very supportive still by a systematic bid. A systematic bid is primarily coming from two places. It's coming from CTAs. The updated numbers I saw this morning is that in a flat S&P tape, they're buying about $13 billion worth of stock, so more than $2 billion of buying per day. And now we are in the full open window for corporate buybacks. So corporate buybacks are adding on an additional $5 to $6 billion of a bid into the market every day. So if you combine just those two cohorts alone, you've got $7-8 billion of buying coming into the market every day. That's just forced buying. It doesn't care about fundamentals, doesn't care about technicals, it doesn't care about the Moodys downgrade of the debt, it doesn't care about any of that. With that said, even knowing that information, getting a 1% plus gap down on interest rates moving higher and Moodys downgrading the debt, this is an incredible bounce back. I think it's also to some degree caused by the fact that a lot of hedge funds are still very underpositioned right now. After unwinding a ton of risk in April with Liberation Day and everything that happened, they're still very underpositioned to the long side. So for those players in the marketplace, the gap down this morning could just be an opportunity to go, oh, we need to add some long exposure. We're so lucky that we got this big gap down this morning so we can add back some long exposure at relatively reasonable prices. But it's crazy. The flip side of the argument is I thought that maybe we could begin to see real selling today with interest rates getting to where they were. So I actually don't think that the Moody's downgrade of U.S. debt is that big of a deal at all. All they're doing is catching up with the other two major rating agencies, which had already downgraded us over the course of the last 10 years or so. So they're just kind of catching up rating-wise with them. It shouldn't be that big of a deal, especially because we've been through this on a couple of occasions before. But the problem is it's like another brick in the wall for interest rates. We've already been verging on a problem of interest rates really getting too high, with the 10-year getting above 4.5%, and the TLT ETF, which is the main thing I look at just for a proxy of the bond market, $85 is a huge support level. It gapped below 85 this morning. So I was telling everybody on the team in my morning meeting, like, let's really make sure to watch TLT 85. If it can get back above that, that could help the market to recover. And it has. It's trading at 85.63 right now as we're having this conversation. So it's recaptured that big level. We'll see if it closes above it today, but so far so good. And that should be enough to help give this market a little bit of a rally back. TLT bouncing back, so as bonds bouncing back, that helps the market. The systematic bid helps the market. The under positioning from the funds creates some sort of a chase into the gap down. But again, even with all that, I thought we would at least have a negative day today, which we still might. We're exactly, S&P is down 0.05% as we're having this conversation. We still could have a red day, but not a real red day. nothing major.
Yeah. That Moodys downgrade came, of course, Friday at the very end of the day. The news came out, I think, like there were a few minutes left in the trading day, right? How are you positioned heading into the weekend with that news happening, and how did you manage this morning with the gap down?
So I was very short on Friday into the close because of the degree of upside extension in the market, if for no other reason. And because I had been thinking that the OPEX, which was Friday, could be the beginning of the end for the positioning squeeze. It still could be the beginning of the end for the positioning squeeze. But the data that I just mentioned means that it's going to be ongoing for at least a little while longer, which doesn't necessarily mean that we have to go up. But last week was historic. Like I said to you earlier, April and May has really been one for the history books. We are, first on the downside, it was like fastest 3-day down move in forever for the NASDAQ, and third fastest ever for the S&P, and all these wild data points that we were able to talk about that make for fantastic and fun headlines. And now we're seeing that on the opposite. One of the things that I like to pay attention to as an indicator is what I call this short-term tactical indicator. We look at it most mornings. My partner, Patrick Haw, usually has it in his morning note, which he publishes around 8:30, 8:45 every morning. It's usually at the end of the note. And it's a short-term tactical, it's like a sentiment indicator, but I've always found that it's been great for if you see that it stays in an extreme zone for several trading sessions in a row. If it's like extremely in what we call the green zone, which means that the market is oversold, or extremely in the red zone, which means that the market is overbought, you can see that short-term tactical be in an extreme zone for 2 to 3 trading sessions. And it's not that unusual to see it in an extreme zone for 3 sessions in a row, but we very rarely see it for 4. And I've almost never seen it. I take that back. Since I've been following that indicator, which has probably been for the last 5 years or so, I've never seen it be in an extreme zone for 5 trading sessions in a row until April, when on the downside, we saw it in an extreme green, like buy zone, which I always say doesn't necessarily mean buy, for 5 trading sessions in a row before it broke. And as of Friday, we just saw it in the extreme red zone for 5 days in a row. I've never seen that before in the history of me watching that. And one of the things I love to remind the traders that I work with is if you trade long enough, anything that can happen will happen. It's just kind of the nature of this business when you're working in probabilities. But this market's historic. So seeing that we're set to close at new highs, market at extreme extension every single day last week, short-term tactical in that extreme red zone for 5 days in a row, I was like, all right, I'm going home, nicely short. Like I even added to my shorts kind of into the close on Friday because of everything I just described. And then lo and behold, I usually on Fridays, it's the one day I turn my computer off very quickly and I just try to get to my weekend, because Friday after market hours, usually nothing's going on. But I had a couple flights to book, so I was on the computer, and then all of a sudden I see the market start crashing, and I was like, oh wow, like what's going on? And the Moodys downgrade occurred, and I was so short that I had a massive P&L swing in my favor. I covered stock all the way down after hours on Friday, and then this morning I got up bright and early, 3 a.m. local time here in Idaho, which is 5 a.m. Eastern, and I logged in, and the market was below those lows that it was trading at even at 8 p.m. on Friday. So I was like, okay, this is great. I'm going to take off even more exposure. So I've used the down move as an opportunity to reduce short exposure to book profit. That's exactly what my game plan said. But the craziest part about it is that we got this downgrade from Moodys, and the market was as extremely overbought as it was. And we, into this move lower this morning, still couldn't even get down to the 80 MA on the daily chart for the SPY or the QQQ. And to me, that's mind-blowing. The fact that we could stay that extended for the entirety of last week, get a bearish catalyst, you could potentially even argue several bearish catalysts over the weekend, and not even be able to get down to what I consider to be the technical equilibrium zone for the S&P or the NASDAQ is honestly mind-blowing. This is the strongest market I have ever seen. And it's just a pure positioning squeeze at this point. It's going to end at some point, but it just continues to go in terms of both time and duration well beyond my expectations.
All right, good question we got from YouTube. Cyril wants to know, says the buying is insane. What is your advice to not try to fight the trend?
So, I mean, it goes back to trading rules, right? So I'm a big believer in having a thesis for the market, because if I have a thesis for the market, and it's usually going to be based more off of like fundamentals, a lot of qualitative fundamentals I employ for that thesis for the market tells me, generally speaking, I would want to be long or I would want to be short. But you still need to listen to the technicals of the market in terms of execution, risk management, reward maximization, and then have game plans for what you do. I'm going to make the most amount of money when the technicals line up with my thought process. My thought process has been bearish. The technicals have not lined up with that. So what that means is it's okay for me to be bearish, but I can't just be blindly shorting with zero risk management. I need to still be waiting for good execution opportunities, good signals on small time frames when I feel like there's the potential of that confirmation, and not be too greedy on the reward side. My big theme that I've been telling all the traders on the team the last 2 months has been be greedy, don't be stupid. There's nothing wrong with being greedy when you're looking at a market that is at an extreme. That's when I think you should be greedy, and usually should be greedy in the other way. We were calling back in April at the absolute low to take longs down there and to be extremely greedy with those buys in terms of your reward profile, but not be stupid. What's the difference? The difference is someone who wants to be greedy but not stupid is going to get their risk covered when the position moves in their favor, is going to book additional profit when the stock or market that you're looking at gets to some key points, maybe some key moving averages or some key previous levels that you're viewing as reward targets. But then we'll still keep a percentage of that position. That could be anywhere from 10 to 40, 50%, depending on just how greedy you want to be. Keeping a smaller percentage of that position after the risk is covered, after you basically ensure that you're going to make money in the trade no matter what, then you go for the home run. So if the trade fails and you get stopped out, no one wants that, but it's part of the business, and you didn't lose money, you made a little bit of money, whatever. But if the trade really works, if the idea really works and gives follow through, then you can get an incredible amount of reward for the risk that you put on. I don't think it's impossible at all for traders to still be long from the April low. If you just had a game plan in place that was greedy but not stupid and implemented some sort of a trailing technique. I mean, look at the uptrend on the S&P on the daily chart. If you have a swing position on and you are implementing proper trailing rules, trailing based on pivot points, when the 80 MA catches up to that pivot point, there's nowhere in the entirety of the submove that you're getting stopped out of your long positions. So you could believe that the market shouldn't continue to go up, but it doesn't matter if it does, right? Because you're going to continue to make money on longs that you're holding, regardless of whether or not you believe the market should be going up, because you're implementing trailing strategies. And if you're trying to put shorts on in this area, I think that makes a lot of sense. But you still have to have a game plan that's going to be booking profit for you when the positions move in your favor, and managing your risk when the positions move against you. It's like I said, into the move on Friday and this morning, I thought that there was more reward potential on that trade. I thought that we could at least see the 80 MA on the daily, if not see like a a midpoint between the 8 and 21 EMA in the SPYs and the Qs. I thought that was very reasonable to look for some additional reward off of a catalyst with the amount of extension that we had. But I was still booking profit. I was still booking profit on my shorts after hours on Friday and this morning, because the fact of the matter is I don't know. I don't know when we're going to stop. I don't know where we're going to pivot up, and I don't have to. And that's my favorite part about trading. Now I'm starting to ramble here a little bit, but I'll make one more final point. One of my favorite things as an exercise to do for myself, and that I recommend for traders that I work with to do, is to admit to themselves they have no idea what the market's going to do. You have no idea what the market's going to do. Like, I'm saying this, I've been doing this professionally for 15 years. I do not know what the market's going to do next. What I do know is that I can look at certain factors that make it so that there is a higher or lower probability of the market moving higher or lower. And I can combine that with basic math beyond that encompasses risk reward. And by utilizing that combination of factors, by utilizing just a study of again, basic math that gives you risk reward and understanding how probability works in the market, I don't need to know what's going to happen next in order to make money. I didn't need to know when we gapped down this morning if we were going to continue to go lower or if we were going to bounce back. I had a game plan in place that said, book some here, be greedy for a bigger move, but book enough here where if we do bounce all the way back to unchanged like we just did, that you're not going to be hurt from it. You're going to make money from it. You're not going to be kicking yourself of, oh, why didn't I cover more stock when we were down there? You need to be comfortable with the activities that you are, with the actions that you're doing in the market, and that's going to be based on those game plans that you establish. So great question.
Good stuff. All right. There are a lot of expressions when it comes to the market, seasonality wise, like for different parts of the year. One of those is sell in May and go away. But I did see an interesting stat over the weekend. I think it was on Twitter somewhere, X, saying that the May after an election actually tends to be one of the strongest months in the year instead of being one of the weakest months in the year. This May has definitely not been a sell in May and go away so far after what we saw happen in April. How are you feeling about the summer months ahead with how the action has been in May so far?
Sure. So sell in May and go away is, I think, a little bit of like a misnomer when it comes to the many common sayings that there are in trading. Many of those common sayings are sayings, by the way, that I disagree with. May is historically a positive month. It's just not one of the strongest months. I think that the historical average over the course of the month of May, going back, I don't know, last 75 years or something, is up like 1% or 1.5%. So May tends to be a positive month. It just doesn't tend to be a massive upside month. And positive is positive. July also tends to be a really strong month for the market. Whereas June, August, and September, I think especially the first half of September, tend to be a little bit weaker. So I think that sell in May and go away saying comes from the fact that the totality of that period from the beginning of May through like mid to late September tends to be a market that gives movement in both directions, but doesn't end up actually going anywhere, because the June, August, September weakness offsets the May and especially July market strength. So a lot of the time, sell in May and go away, it just means that, like, especially if you're an investor, you're not really going to be missing a lot of upside performance in the market over that period of time. But for traders, it can be a great period of time, because everything that I just described, June being weaker, but then July being an extremely strong month, and then August, September being weaker, we can trade both sides of the market. So that movement, that volatility, that can actually be a huge edge and a huge advantage for us.
All right. Question from YouTube. Someone wants your opinion on UNH, United Health Group. Do you want to pull up your charts and we can look at it?
Yeah, I can pull it up real quick. So I have not traded UNH at all throughout the entirety of this saga. I have most definitely been watching it, because how could you not? Look, UNH as a company is not going anywhere. So at a certain point somewhere, this thing's going to get a bid. But in the face of all that negative news, trying to pick that exact spot is obviously really difficult with the ousting of the CEO and the potential of scandal that's happening with the investigation that's ongoing now in UNH. It was just like one thing led to the next. So you started with this really big sell-off. Remember, a lot of people were like, where's the bottom going to be? Where's the bottom going to be in this initial move? And there were a couple like pivot points where you could have attempted to buy this thing. But then, like I was just saying before, you put your trade on, you recognize that there's a reward profile for it. It probably would not have hit any of your targets on the upside, but maybe was enough to get your risk covered. And then you get stopped out and you move on, or you get stopped out and you patiently wait for the next trade setup to kind of manifest. This continued to grind down. Then it got hit with the news, and that news was a doozy. Huge gap down, and then just all this continuation here. Finally, on a huge volume day, you closed with a big, I guess it's technically a dragonfly doji, which is basically the same thing for all intents and purposes as a hammer on high volume with a massive amount of downside extension. And now you're getting some follow through. And today, I think it's particularly strong because there was some insider buying. I think that the CEO bought a bunch of shares. I do not recall off the top of my head how much, but that's helping to propel the stock higher, and it's up 8%. Even with this bounce back, right? 2 trading sessions ago, it was at 249. Now it's at 314 and change. It still hasn't even caught up to its equilibrium zone as represented by the blue line here, which is the ADMA. Again, as a reminder, I view the technical equilibrium zone for any stock on any time frame to be the space between the 8 and 21 EMA. So the fact that it's still trading beneath that tells me that there is still some more room for this thing to bounce. This thing could easily get back to 325. Like, this moving average will continue to go down. Stock continues to go up. This thing could easily get back to 325. But I don't think it's a good risk reward to buy it now. This thing just bounced, what did I just say, from like under $250. So it's given a $65 bounce. You're going to buy it here to look for potentially the next 10. It's not a good risk reward at this point, in my opinion, to buy the stock, but I wouldn't be shorting it here either. It's also still too early. That like at a minimum, I want to see the stock at the ADMA before I would consider shorting it. And honestly, when the spread widens this much between the 8 and 21 EMA, a lot of times these stocks will overshoot where the ADMA is. And then you've got a big gap here. So this thing might find some resistance prior to the beginning of this gap at like 340, 343. That would be a spot that I would watch. So if I was already long, I would be looking to book some profit into the ADMA, book some profit into this 340 to 343 area, and then kind of like this midpoint between those moving averages, like 355 to 360, would be like the third spot. And those exact same spots I was just mentioning as good spots to book profit on longs would be spots where you could potentially begin to look for it on the short side, but still with a setup. Yeah, that's it. That's my analysis for you.
All right. I know you start broad market for ideas and setups, and then you narrow it down to individual tickers. So talk to me about what you're currently liking in this market and the overall market picture for yourself.
So this market needs to reset up is the biggest thing. Like from an index level right now, there is just no setup in this market. And I was hoping, for the sake of not just my own positions, but just for the sake of good trading opportunity, that the gap down this morning would lead to a broader correction through time and through price, because that's how setups happen. And that could be more actionable. But here we are once again, as we're having this conversation with the SPY at 594.50, with the ADMA at 584. We've got just over $10 of extension from the ADMA in the SPYs. That's what I consider to be extreme upside extension. So if I'm starting with the market before I work my way down to any individual stocks, sure, there can be some one-off names that report earnings that could be interesting. And when a company reports earnings, its correlation to the market gets reduced. So you can look at a company that reported earnings in a bit of a vacuum, where you don't have to be as concerned of, oh, I don't want to buy this stock because the SPY is so extended. That might not matter on an earnings report. So any name you can day trade, the day after an earnings report, if there are good setups that are there that you can make a few dollars from, But from the big picture here, I can't buy this market. I don't care if we go to 600. I don't care if we go to 605. I have trading rules. My trading rules say don't chase. They say do not buy a market that's got more than $10 of extension, especially when it's a day. If we close green today, a day 6 to the upside and extreme extension with the short-term tactical that I was just telling you about before, I can't short that. I mean, I can't buy that. But try to short this market, you're going to go bald. I still got all my hair somehow, but I'm going to go bald if I'm blindly shorting this market. It's just the underlying bid on it is extreme. So, what I want before I can even look at any individual stocks is just a better setup from the market. If the SPYs could have been weaker today, if they could have retested 580, that would have been the first spot. All right, we're at 580. What stocks are showing relative strength? What stocks didn't pull back as much as the market did? What stocks are giving good daily chart technical patterns that I can potentially buy? So that'd be the first spot I would look at. And the big spot I would look at if you want to be a bull at all, and the way we're trading, we'll never see it ever again, it would be SPY 570. SPY 570 is the huge level. That's where the gap fill is. You'd be fully filling the gap from the China-US thing last Monday, the pause. And it's a previous resistance level. It was a resistance level back in March. It was a resistance level in May. 570 is a huge level. If we could retest that, I'd be heavily looking for potential long setups in this market. But here, I can't justify buying anything. And can I short? I need a setup. I still need the setup. That's what I'm looking for. That's what I'm looking for. I'm looking for the short setup. I'm looking for it on a small time frame. Give me an RDR today, right? On day 6 to the upside that could potentially be shortable as just an example. And then I could start with the market and I could break it down. And I could be like, all right, well, what's relatively weak? Apple was very relatively weak this morning. That's notable, though it's recovered a decent amount. Tesla was very relatively weak this morning, though now it's beginning to recover as well. I mean, it's almost impossible for any stock to stay down if the market is rallying as much as it has been. Tesla's still down 3%, though, with the SPY green right now as we're having this conversation. Q's just got to exactly unchanged right now. So that's where relative weakness is as well. So maybe if I can see a signal that comes in on the SPY or the Q's, then maybe I could look at Tesla's relative weakness for a short setup or Apple's early relative weakness to see if that comes back for a short setup.
All right, good stuff. All right, Derrick is a real trader, so I'm going to let him get back to that. If you'd like his free ebook, go to t3live.com/DOLive. Again, Derrick is the head trader at T3 Trading Group, and his ebook is about the benefits of prop trading and how you can work with him and T3 Trading Group as well. So you can get t3live.com/DOLive. Next week is Memorial Day, so Derrick and everyone in the market, we will be enjoying a 3-day weekend. So we will not be back. So we'll be back in 2 weeks. Derrick, enjoy the long weekend. Have a great trading week. I hope you get some good setups that come up for you. And I'll see you in 2 weeks.
Thank you, Greta. Talk to you soon.
All right, bye.